Hello, everyone, and welcome to PACE's next webinar. Today's topic is supply chain profitability and cost management. And I'm excited today to be joined by Gary Cokins, Director of PACE. For those of you who are not familiar with PACE, we're the Profitability Analytics Center of Excellence. We're a group of volunteer professionals dedicated to helping organizations make better, more informed decisions through the use of data analytics. We do this through the use of integrated causal models following our profitability analytics framework. If you'd like to become a member, it's free. You can get access to all of our varied resources, our webinars, podcasts, articles, ebooks, interest groups, and more. You can go to profitability-analytics.org to sign up and keep an eye out for our upcoming virtual conference happening this September 24th and 25th. So here's a little bit of housekeeping. If you'd like to receive a certificate of attendance for today, please be sure to use your actual first and last name when you sign in. If you need to edit the name on your screen, click Participants, which is located at the bottom of your screen, and then hover over your name on the list. Click the three dots, and there's an option there to rename. Now note, you have to attend at least 50 minutes of this presentation and answer at least 3 polling questions to receive a certificate. The session is being recorded, so please keep your camera off and your microphone muted until the Q&A session. Please hold your questions until the end or type them in the chat and we'll answer them at the end of the session. And now over to you, Gary.
Well, thank you very much, Rafe, for your message. A little bit about myself. My name is Gary Cokins. I received my Bachelor of Science in Industrial Engineering and Operations Research from Cornell University in 1971, my MBA from Northwestern Kellogg School in 74. If you're doing the math, I am 76 years old, but I feel like I'm 46 years old. My career was pretty much in, I think, 3/3. I started in industry with FMC Corporation Link Belt as a division controller and then operations manager. Then many years in consulting, 7 years with Deloitte, 5 years with KPMG, 5 years with EDS. And then 8 years ago, I retired from SaaS. I have been with SaaS for 16 years. Many are not familiar. What's SaaS? It's actually the world's largest privately owned software vendor, data science and analytics with 15,000 employees. So why are those books there? I think careers have a lot more to do with luck and circumstances than being smart and competent. I had 2 lucky breaks. When I was 27 years old, I was a division controller in Milwaukee. Oh, I'm a native of Chicago. Go Cubs, go Bears, go White Sox. Those of you who are familiar with sports teams. But I was in Milwaukee and as a division controller, and I had the opportunity to become the operations manager in the factory. And I used the phrase, I then had to eat the accounting data that I had been serving as the financial controller upstairs. I found much of that information to be at best useless and at worst dysfunctional and misleading. And that was a real wake-up call to me about the difference between external statutory regulatory reporting and internal management accounting used for insights and making decisions. My next big break was later on in 1988. KPMG struck an exclusive contract with Harvard Business School professor Robert S. Kaplan. Many of you will recognize his name as the co-creator of the balanced scorecard, but he did the early pioneering work in activity-based costing. So I got recruited to be trained by him for 5 years. I implemented ABC. I wrote a book, and it led to more books. And please do not criticize me for, oh, he's pushing his books. No, you do not need to buy my books. What you can do, though, is go to wiley.com, WILEY.com, and Chapter 1 is a free download, and Chapter 1 will give you a pretty good view of what's in the book. So let's get going. Who will benefit from this presentation? Managers who have previously struggled at promoting enterprise performance management, EPM, supply chain management, SCM, and integrating business analytics into their decision support systems. Managers who intend to champion any or all EPM, SCM, and business analytic improvement techniques, and they need a compelling call to action. And the reason I have champion in quotation marks is it's been my observation that although it's nice for senior executives to advocate innovation and new ideas, Often they are preoccupied with firefighting and short-term priorities. So it's typically managers 1, 2, 3 levels down in the org chart who basically ask themselves, how long do I want our organization to continue to perpetuate using stale or arcane or flawed or misleading methods? And they're the ones that'll do a pilot project or a proof of concept to demonstrate to their other line managers, employee teams, executives above them that this is the way to go. So if you're early in your career or low down in the org chart, that's fine. I like presenting to you. So the learning objectives, I'll read the ones in italics and then you can read the others. One, to identify and evaluate collaboration opportunities within the supply chain. 2, applying activity-based costing ABC principles. 3, how to segment and prioritize customers for profitability, measuring customer profitability. 4, recognize and address barriers and obstacles that are slowing the adoption rate of enterprise performance management and supply chain management. And 5, finally, how to interpret financial data for supply chain decision-making. So my agenda is I'm first going to clarify what is the confusion and lack of consensus. What is enterprise performance management? Then next, why is trading partner in a supply chain collaboration needed? Then I'm going to have to do a kind of a primer on managerial accounting and how it applies to supply chain management. And then I'm going to conclude with a really important topic for me, really a frustration. What is taking so long for organizations to implement these progressive methods? I like to start with this cartoon, drowning in data, but starving for information. You have this poor beleaguered clerk in the chair, sad, shoulders hunched, paper all around him, and the supervisor in the doorway to the left is asking him, looks like you've got all the data. What's the holdup? I gave you the request this morning. Why don't you have the answer this afternoon? And the message here is there's a difference between data and information. Data is typically extracted or collected transactionally, purchasing orders, payroll systems, invoicing systems. You convert that data into information for insights and decision making. So let's clarify the confusion about performance management. There is lack of consensus about it. Is it human resources performance management? If you do an internet search just on the 2 words performance management, the majority of the hits are going to be the human resources and personnel function, like, employee appraisals. The problem there is authors like me, and there's a few others who've authored books, we neglected to put the E, enterprise performance management, often called C, corporate performance management, in our title. Is it about scorecards, dashboards, KPIs, and measures? Yes, but that's a subset. Is it about the alignment of employees with their decisions and priorities with the strategy of the executives? Yes, but that's also a subset. That's for the world of strategy maps and balanced scorecards. Is it about process, productivity, and quality improvement? Yes, but that's another subset. Those 3 are referred to as business process management, BPM. They involve lean management, Six Sigma quality, and so forth. Or is it all the above and possibly even more? And the answer is it is. And the good news is this. The enterprise performance management methods, many of you are already familiar with. You've read articles in journals or magazines about them. The problem is when companies do implement some or many of them, they do it in isolation of each other. So you've got planning and budgeting people in one part of the building. You've got profitability reporting and pricing in another part of the building. Enterprise risk management in another part of the building. Process improvement, lean management, another part of the building, and so forth. And the issue here is you get a lot more synergy and power when you seamlessly integrate all of these methods like gears in a machine, and even more power when you embed analytics of all flavors, regression, correlation into the methods. So, because you will get these slides, here's the definition I just read. It's the integration of multiple methodologies with each embedded with business analytics, such as segmentation analysis, especially predictive analytics. And make no mistake, the purpose is to achieve the executive team strategy and to make better decisions. Now, what's caused interest in EPM? I'm going to quickly go through this list, and then I'm going to zero in on number 7, and that'll be the rest of the presentation. The first cause is executive frustration with strategy failure. Most executives are quite good at formulating strategy. Their frustration is failure to successfully implement the strategy. And there's empirical evidence on this. There's an executive recruiting firm in Chicago that monitors the involuntary turnover of CEOs in North America. The firing of CEOs is increasing every year. And my belief is the reason is post-Enron, executive board of directors take their job far more seriously than ceremonial. So if the CEO is not implementing the strategy, they fire him. Next, increased accountability. Today, there is no place to hide. Managers, employees will be monitored. They will be measured. It doesn't necessarily mean their jobs are at risk with security, but it could adversely impact their salary increases or job promotions. 3, more rapid decision making. Unlike a few years ago when you could test and learn and have meetings in conference rooms, today people will be on the phone, go or no go, yes or no. They have to make that decision in real time. They almost wish that an executive was sitting next to them. What should I do? Number 4, mistrust of the managerial accounting system for transparency and accuracy. The reality is most managers do not trust the management accounting system for accuracy. Why? The vain overhead cost allocations. We'll talk about how activity-based costing resolves that. 5, poor customer value management. The reality is customers are the source of value wealth creation for shareholders and owners. We need to connect the actions we take with customers and how the consequences result in profits for the shareholders. But we have a problem. The accountants are not measuring customer profitability. They're stopping halfway down the income statement with this gross profit or service line margin. We need to continue to conclude channel distribution expenses, marketing expenses, selling expenses, cost to serve to get a profit and loss statement for each customer. I'll talk about that later. And 7, this topic, dysfunctional supply chain management. And I'll just briefly introduce it. The problem is most customers view their suppliers as the enemy. It's an adversarial relationship. Well, if we can lower the price with our customer, with our supplier, and we put them out of business, so what? We'll get another supplier. That behavior has to stop. It needs to be a marriage. Supply chains are competing against other supply chains for share of wallet. And finally, number 8, unfulfilled return on investment promises from large IT systems like enterprise resource planning systems. And the issue here is if you talk to the chief information officer, the IT director of a company, 2 years after you've gone through the big effort of implementing the ERP system, you ask that IT director, how well do you believe that ROI has met or exceeded what the ERP software salesman sold you on 2 years ago? Many of them will be hard pressed to say yes. Whoa, we've gone through a couple of years implementing this. I'm not sure we've got the payback. That does not mean you don't implement the ERP system. You have to. Your competitors already have it. But the problem is that ERP systems produce a lot of the data, but not the information. And what the enterprise performance management methods do is they convert the data into the information for insights and decisions. So we're at polling question number 1, Rafe.
13% EPM systems, 42% ERP systems, 13% BI tools, 33% spreadsheets.
Okay. Oh, there it is. So let's move on to the second part of the agenda. Oh, I have to keep clicking my mouse to. So most of this presentation is going to be based on a book that I co-authored with 2 university faculty at the University of North Texas, Tom Clammer, Terry Poland. It's called Supply Chain Costing and Performance Management. So here's some of the issues, post-ERP and supply chain management challenges. Since the 1970s until today, businesses embraced ERP and supply chain management to automate relationships and to increase efficiencies. These either eliminated or shifted costs between the trading partners, but they didn't address these 3 key challenges. Here's the first one, I've already referred to it, adversarial relationships. While each trading partner knows that there are mutual profits to be gained, decades of arm's length and adversarial behavior has precluded the efficiency gains between the trading partners. Number two, a procurement focus. There's immense pressure is being placed on the suppliers downstream for price reductions or containment without regard to effects on service level. So let's use that example that you do negotiate a lower price with your supplier and you stay with them. But because they've got they're going to have lower profit and they start still expected by their shareholders and owners, they may, if you will, start reducing some of the services to you. So it's going to have not a good impact on the quality of the service. They may start missing due dates and the like. So the pressure goes from right to left. Three, a suboptimal internal focus. It is no longer sufficient for your organization to be the most agile, lean, and efficient firm. You are codependent on all of your trading partners, upstream and downstream, to also be agile, lean, and efficient. Like I said, supply chains are competing against other supply chains for share of wallet. So eventually, this creates a need for collaboration, talking to each other, trading partners, customer with the supplier. And I'm going to give an example right now. Maybe it'll be later, but I want to give you examples so you can relate. Let's imagine that the receiving people from a supplier get this crate on a skid that's all wrapped up and they have to take, a half hour to undo all of it. If they had a meeting with the shipping people at the supplier and said, hey, can you create a special skid that's got some foundation to it and you can basically insert what you're sending to me so there's no need to have to do all the wrapping. That'll save us not the half hour that's taking on our end. Notice what that did. It also saves time on the supplier side to have to do all the strapping. So there's an example of cost savings for both the supplier and for the customer. But first you need to know the facts to know what are your own costs and profit margins are and who and what is costing them. That leads us to having to talk about managerial accounting. So here's a quote from a retired Walmart supply chain vice president, Robert Bruce. Many companies may find it near impossible to track supply chain costs, but it is a requirement for properly tracking, reporting, and measuring item performance. And it is a true prerequisite for advanced supply chain and retail optimization. So here is a kind of a graphic of a supply chain, and let's just look at one interface between the seller and the buyer. All the way across it, I refer to it as the information conduit. The starting point to measure profits across the supply chain and to identify those joint mutually beneficial opportunities, like the one I just described about the receiving clerks and the shipping clerks, begins at any seller-buyer interface along the chain. So we now need to talk about ABC. And here's a simple way to understand it. Imagine you go to a restaurant with three other friends. You order a little salad, and the other three order the most expensive item on the menu. And at the end of the meal, when the waiter or waitress brings the bill, the other three say, hey, let's split this check evenly. How do you feel? Not fair, not equitable. Well, that's how products and standard service lines also feel when the accountants take this large amount of overhead, more properly called indirect expense, and they allocate it to those outputs, to the products or services, like spreading butter across bread, using cost allocation factors like number of labor hours, number of units produced, square feet, square meters, number of employees in a cost center, and so forth. None of those cost allocation factors reflect the true consumption that those outputs, those products consume of the end-to-end business processes and the work activities that belong to those processes, which in turn draw on and consume the resource expenses, salary, supply, travel, and so forth. So if you were to decompose the overhead, which is typically a big fat single pool, into multiple cost pools and trace and assign them with a cause and effect relationship, the causality principle, which is foundational to management accounting, you will discover, compared to that flawed butter spreading, in reality, some of those products were way overcosted. The others must be undercosted because it's a zero-sum error game. And that means that the accountants are providing flawed and misleading information to their managers. Oh, yes, it does reconcile exactly to satisfy the external audit, and the audit firms like EY, Pricewaterhouse, KPMG, but it is wrong in the parts. So the simple explanation or definition of ABC is as if the waiter or waitress brings 4 individual checks. You only pay for what you consume. So, Rafe, we're at polling question number 2. I'll read the question. Our organization's cost accounting system calculates, and here you can describe how it's calculated in your organization. And there we go. Well, not too surprising. Over 50% are still doing the traditional method, but that is the pattern I've been seeing. There's still a lot of upside opportunity for organizations, controllers, and CFOs to improve the information for their managers. So, why the need for ABC over time? This chart shows the 3 universal components of any organization's expense and cost structure. You've got that overhead at the top, direct material in the middle, and the direct or recurring labor at the bottom. Notice over time, what's happening is the indirect expense is displacing the direct. And when you ask managers, why is this happening? They'll say, well, automation, machinery, robots, we're automating the frontline workers. That is secondary. The primary reason of this displacement is over time, all organizations have had an increased proliferation of different types of products, manufacturers, more colors, more sizes, more ranges, banks, insurance companies, more policies, more types of depository accounts. The point is this. When you increase the diversity and variation and expansion of your products, it just produces complexity. And the complexity causes the need for more and more indirect expense to manage the complexity. So 30, 40 years ago, when you had few diversity, let's use a black pen company. All they make was black pen. Imagine what you see in the warehouse, barrels of black ink, some tubes. But now, later, when there's 50 colors, yellow, red, orange, now look at that warehouse, a lot more complexity, forklift drivers and so forth. That's what causes the need for ABC. Now, the problem actually begins with the traditional responsibility cost center statement. Every manager on the planet Earth recognizes this report, salary, equipment, travel, and so forth. But the problem is when managers receive this report, they ask themselves, how much insight and understanding do I get about the cost that I can influence and control and where it goes? And the answer is not much. I like to say when managers get this kind of report, they are either happy or sad, but they're rarely any smarter. What activity-based costing does, it makes them smarter. And the way it does it is by converting the data on the left into the information. Notice in the middle, it's the same 914,500, but now it's been converted into the language of work. Key scan claims, analyze claims. Notice I'm using the back office of an insurance company. It's a factory too. And ABC applies universally to all organizations, service, even government. And then it reassigns the 914,000 to the products and customers, just like the waiter or waitress in the restaurant, based on a cause and effect relationship. Now, I've rotated the previous diagram 90 degrees. It isn't quite simple as, we take our ledger expenses from the cost centers, we put them into these activity cost pools, we trace them to the products. No, the right side is more realistic because you've got support departments that support other support departments that ultimately support the frontline departments that interact with customers, deliver products and customers. So it must be multiple cost flowing. So I know this is a complex diagram. Be patient. The next slide, when you get it, will be a link to a statement of management article I wrote on ABC, published by the Institute of Management Accountants. I'm a 30-year member of the IMA. So what you're seeing here is the multiple stage assignment network. We've got the resource expenses at the top, we've got the work activities in the middle, and then they pile up into the final cost objects, which is the products and customers and so forth. Okay. Think of all of those arrows as thin straws or wide pipes where the diameter reflects the amount of money. That's why this will always reconcile. So if the organization, let's say, spent $2 million in January, it'll be exactly $2 million of work activities. And that 2 million will pile up into the two bottom right boxes in the final cost objects, customers and business sustaining. A little bit of definition. Business sustaining, what's that? There are going to be some expenses that have nothing to do with making products, delivering services, interacting with customers. Things like the legal department. So we create a final cost object called senior management. Another example would be when the accounting department's closing the books. You can't allocate it to any product or service. It's not connected. Notice in the activities, there are two red boxes that go cost to serve. They're not going to the product, they're going directly to the customer. And we'll see that that's going to be those distribution, channel expenses, selling expenses, marketing, and so forth. Direct cost, not broken. You may have data integrity issues with that, but the IT department and operations can fix that. And as I mentioned to you, I went through that very quickly, maybe too fast for you. If you go to the link in this report when you get your PDF, it will take you, it's about a 20-page statement, and all of the slides, or many of the slides I'm going to describe here are in that paper. Now, what's the result when you do ABC? This graph, the vertical axis is the percent error distortion. The horizontal axis, look at that dashed line in the middle. That's going to be your traditional costing, the butter spreading, labor hours, units produced. The backward S curve is the result of the ABC. Now it's going to exactly reconcile to the penny or to the euro. But what you see is to the left side, those simple products, they've actually been overcosted. So they're really hidden profit. Okay, that's like you in the restaurant ordering the salad. To the right side, the complex products, okay, they will have been undercosted in reality with ABC. So you're actually losing money, but not knowing it. What's the consequence? Couple of things. For the left side, because you've overcosted products, your competitors are going to basically see, wow, they're pricing it so high. Let's just price it a little bit below them and we'll steal market share from them because their price is way too high. But on the right side, it's worse. The sales force, your sales force, is of the impression that certain products are very profitable. In reality, they're not. Some of them are actually unprofitable, and they're selling more. So the more they sell, the more your company loses money or the profit margins decline. Here's another view of the actual results, and you're looking at real data here. This graph, the vertical axis is the net revenues minus the properly calculated and traced ABC cost using the multi-stage cost assignment network. The horizontal axis is the cumulative buildup of the profits, and it's rank ordered starting with the most profitable product, the second most profitable product, and so on and so forth. These are often referred to as humpback whale curves or whale curves because notice it looks like a humpback whale. Okay, the last data point to the right will exactly reconcile with the P&L. So in this particular company, and this is a real data from a real company, they had 30 million in sales for the quarter, 20 in expenses to net out at 2. The last data point is 2. There's always organization shock when the management team sees this whale curve. Because in this case, it said, look, you made roughly $8 million of unrealized profit based on 3/4 of your most profitable products. You lost $6 million on the remainder to net out on 2. And they can't believe it because their belief system is the graph is this little blue line. And that's because the accountants with that broad brushed allocations, labor hours, units produced, was basically suppressing and crushing any accuracy. And the ABC multiple stage assignment network and all of its driver quantities to construct it is detecting the differences and it's producing the top line. So the top line is the truth, the blue line's bad. Unfortunately, the managers the executives are making decisions. And if you remember anything from this entire presentation, remember this. In the absence of facts, anybody's opinion is a good one. I'll repeat that. In the absence of facts, anybody's opinion is a good one. But usually the biggest opinion wins, which is the opinion of your boss or the boss of their boss. So to the degree they're making decisions based on flawed or misleading information, like the blue line below, your organization is at risk. Now, some of you are basically saying to yourself, oh, Gary, I've heard about ABC. It doesn't work. It's too big. It's complicated. My brother-in-law works for a company. They tried to put it in. It failed. So there's all these misconceptions that ABC doesn't work. And the problem was, in the past, oftentimes consulting firms made the initial ABC model way too large, way too complex. No one could understand it. They were unmaintainable. I fortunately, early in my career, when working with KPMG, came up and advocate a much faster, more effective way to implement ABC in 3 weeks, not 6 months. It starts with, notice, Model Zero. It's a one-day workshop with 5, 6 cross-functional employees in a room, line managers. We build a high-level model, not intended to be accurate. Usually we bring in commercial software, ABC software. It doesn't have to be purchased. It's just being used to basically as an example. And the next morning, we bring in the other line managers, the executives. They see what these 5 or 6 people constructed. The light bulbs go on with everybody. Oh, that's how we get rid of that butter spreading of indirect or overhead costs. Oh, that's how we could do benchmarking with apples and apples, not apples and Oreos. Oh, that's how we can go below the gross profit line, margin line, and see customer profitability. They get it. They get buy-in. And at the end of that meeting, I basically, in the workshop, asked those people on a flip chart, in 3 weeks, this is going to be a permanent, repeatable, reliable production system. What decisions will you make with it? Some of them say, oh, we can validate our pricing. Oh, we can basically do better quoting. Oh, and so on and so forth. They're getting the buy-in. Then it just takes a couple of iterations, start replacing a lot of the percentage estimates, because in a rapid prototype, everything we use percentages, 10, 10, 80, 30, 30, 40. You know, when you're allocating costs, everything normalizes to 100%. So in the iterations, we can start extracting data from the ERP systems, replace the percentages with real numbers. We get a real good numbers. Make your mistakes early and often, not when the system is too difficult to change. Now, why does rapid prototyping work? It has to do with this graph. The vertical axis is the accuracy of what you might want to know. Let's just say a product cost. The horizontal axis is the level of administrative effort to collect the data, calculate the data, report the data. You will always get an asymptotic curve that starts increasing relatively quickly, and then it levels off to the right with diminishing returns on extra accuracy with the extra effort of work. What the rapid prototyping does is it creates this thick black line. Notice the slope goes up relatively quickly and then it levels off to the right. And when you ask people, what do you think is the determinant that influences that slope? Many people say, oh, timesheets, daily timesheets from employees. No, you don't need daily timesheets. You can basically use estimates. What produces that slope going up vertically quickly is the multiple stage cost assignment network. You know, costing is modeling. It's not T accounts and journal entries. You're modeling the relationship, the consumption relationship of outputs to the work processes with the activities in them that in turn consume the resource expenses and capacity, you know. And it doesn't have to be precise. It's good enough. Yes, for external financial reporting, yeah, you get those numbers wrong, you go to jail. But if you get the management accounting numbers wrong, you don't go to jail. So you don't have to ease up. It's far superior, that black slope line, than that butter spreading. So Rafe, we're at our next polling question, number 3. Okay, and the vast majority of you got it correct, that 91%. Incidentally, I neglected to mention that whale curve, you know, looked like a crummy graph to probably say, wow, that doesn't look very good. That was my very first ABC implementation with KPMG. Pete Warmark was when I joined them in 1988. And there are now always whale curves, always show up. So now let's talk about customer profitability. Value of a company is equal to the value from customers. The only value a company will ever create is the value that comes from its customers, the current ones, and the new customers acquired in the future. To remain competitive, one must determine how to keep customers longer, grow them into bigger customers, make them more profitable, and serve them more efficiently, and acquire relatively more profitable customers like your existing profitable customers. But we've got a couple of problems here. First, the CFO and the controller are rarely calculating customer profitability correctly using ABC principles. So what about the below those, the gross profit margin line? Products and standard service lines are not the only thing for which accountants should compute costs for. What about the costs that have nothing to do with making products and delivering standard service lines? The problem with traditional accounting's product gross profit margin reporting is you don't see the bottom half of the picture below the gross profit margin line. And I'm going to make a case that the bottom half is more critical and important than the top half. Visually, what I'm showing is if the entire rectangle here, let's say that the expenses in January, the accountants are only calculating for the shaded area. They're not including the white area, distribution, sales, and marketing, general accounting, and so forth. So what management accounting must do is help the sales and marketing functions. They need to know the best types of products, channels, and customers to retain, to grow, to win back and acquire, which types not. And here's another problem. Angel customers and demon customers. What do we mean by this? Every company will have high and low maintenance customers. Examples of high maintenance customers, always changing delivery schedules, always demanding special, not standard products, always returning goods, always calling help desk. Low maintenance customers, the angels, we love them. Never change delivery schedule, never only buy standard, never return goods, never call help desk. If those two types of customers, polar opposites, bought the same volume, same mix, same price, they're not equally profitable because the high maintenance demon customers are causing so much extra work. So the message here is sales volume is not equivalent or synonymous with the profit from a customer. But what really caught my attention was the subtitle of this book, Discover Which Type of Customer is Which and Turbocharge Your Stock Price. And this is what I mentioned earlier, that we want to connect our actions with our customers, how we basically induce them to buy more, with our shareholders and owners. Incidentally, this book is authored by two faculty from Columbia University in marketing. There's not much in this book about management accounting. So let's sort of summarize. Profitable and unprofitable customers, they're distinguished by how they place demands on work activities. Let's look at the demons, the less profitable customers. Ordering small order quantities, special products are ordered, heavy price discounting, unpredictable demands. They're always changing delivery times, high technical support, that's indirect overhead, slow payment, not paying on time. We love the angel customers, large order sizes, only buy standard, little price discounting, maybe no price discounting, predictable demands, delivery times are standard, low technical support, maybe no technical support, and they pay on time. So this behavior can be measured by activity costs and activity cost drivers. Now, here's a decomposition of the multiple stage cost assignment network. Again, this diagram will be in that IMA statement of accounting if you want to download it. But you'll notice as we go from left to right, we're bringing in all of the activities. Typical ABC system will have 50 to 70 activities, and each of them are piling up. But what that allows us to do as we go layer by layer to the right is produce a customer profit and loss statement for each customer. And it's got all the layers like an onion skin. So there's a tremendous amount of visibility to basically do analytics, FP&A, financial planning and analysis about what differentiates more and less profitable customers from each other. And you'll notice there are going to be two broad swaths of profits. In this one, there's a 30% composite gross profit margin average, But between the 30 and the 8 at the below, 22 more points of profitability are eroded, nothing to do with the products, but all with channel, selling, marketing, and so forth. So if you calculated those two broad swaths for every single customer, you can put them on a grid that looks like this, where each of the customer is a circle intersection. The vertical axis is the product mix gross profit margin, high or low, and the horizontal axis is that cost to serve, angels on the left, high maintenance demon customers on the right. And now things become obvious. The most unprofitable customers are in the lower right because they're buying low profit margin mix of your product mix and they're difficult to serve. The most profitable customers are on the upper left because they're buying high profit margin mix from you and they're easy to serve. And now the name of the game is move the dots from the bottom right to the upper left, make customers more profitable. So what's happening here is there needs to be a shift in the CFO's emphasis. Typically, the CFO and controller pound on operations to get their costs down. No, we need to shift our attention not from cost management of the operations people, but to help sales and marketing to better target customers. The spending budget for sales and marketing is critical, but it should be treated as a preciously scarce resource to be aimed at generating the highest long-term profits. So this means answering questions like, which type of customer is attractive to newly acquire, to retain, to grow, or to win back, and which types of customers are not attractive? And then for that subset, for the types of customers that are attractive, the next question is, how much should we optimally spend attracting, retaining, growing, or recovering each customer microsegment? And the reason I have optimally in italics is it ultimately is an optimization problem. Why? Because remember, you want to manage the services to the different customers to a point where they'll be more profitable. Now, for some of the people listening here, you're saying, Gary, I don't really care about profit margins. I'm in that cost management group. You can use ABC also for what's called lean accounting. So here is a simplistic example of the multi-stage cost assignment network. Notice all the X's are the activities, and then they're piling up into products, types of orders, and customers. But the same ABC model, you can string the activities like pearls in a necklace from end to end for different processes, and they produce what are called value stream maps. So the lean management community has a companion called lean accounting. It produces the value stream maps. And then what the operations people do is they will tag or score each activity as high value add, low value added, and what are called attributes. It helps them focus on where cost reduction opportunities exist. So we're at polling question number 4. What type of accounting has the highest value to an organization's management and employees? Okay, you got it right. The management accounting brings the most value of the hierarchy of cost. I actually call it the taxonomy. So I'm going to conclude with my big frustration. Why has the adoption rate for EPM's methods with supply chain management been so slow? Why is the adoption rate? What are the barriers? One of the barriers are technical barriers. They include IT-related issues. This is such as dirty data, poor quality input data, their typo errors or whatever. But our IT has a tool called extraction, transform, and load, ETL. It can fix that. I'll give you an example of ETL. Let's say you're a larger conglomerate with multiple divisions, and at headquarters, they want to basically do price negotiations with a big customer, with a big supplier. Let's say it's General Electric. So in one of the divisions in the vendor master file, they've got General Electric as GEN apostrophe L Electric. Another one's got General Electric spelled out. A third division in their master file, they got GE. So it's going to look like 3 different companies. ETL will standardize on one. Let's say it's General Electric spelled out. Hit click. All of the now vendor master files of all the divisions are now standardized. Now you bring in the information headquarters, they see the sales volume with General Electric, so the purchasing people can negotiate lower prices. Another IT related issue is multiple software hardware vendors. Some got Dell, some got IBM, some got HP. IT can fix that. The next problem is the perception barrier of excess complexity and affordability. I already gave you the example and just presume that many of you said, oh, ABC, too complex, doesn't work. I showed you you can have a permanent, repeatable, reliable ABC system in 3 weeks using the rapid prototyping with iteration methods. Yeah. But the real problem, the biggest barrier, has got nothing to do with technology, with software. It's about people. And it starts with resistance to change. It's human nature. People like the status quo, don't rock my boat, but other people related issues, fear of being measured, fear of being held accountable, fear of others knowing the truth. Oh, I don't want the other departments to know what my costs are, weak leadership. There, I said it. I put it on the table. Not every executive team has the highest IQ. So, what this means is you're going to need skills like behavioral change management to get buy in and basically overcome that resistance to change. But many accountants have hard skills, but they don't have enough of the soft skills needed for behavioral change management. So your success depends on how well and how fast the right information and intelligence gets to the right people. And I want to go back up to number 3 here a little bit. Before we get to the Q&A. One way to overcome resistance is basically through asking pain questions. Ask the executive team, do we know where we make or lose money? And start explaining to them, well, look how we allocate these costs. They're flawed and misleading. What it really means is most managers, probably like you, are what I call Newtonian managers, like Isaac Newton, the physicist. To you, the world's a big machine. Give me the levers, pulleys, and dials. What you need to be is a little Darwinian, like Charles Darwin, the biologist, sense and respond, the people related stuff. Do not underestimate this need for people resistance to change to overcome it. So there is my website. And incidentally, across under the horizontal tabs in my website are a lot of links to articles that I've written. Nothing you have to pay for. Everything is free in my website. And if you care to directly communicate with me, there is my email address, gcokins@garycokins.com. And I'm going to turn it back to Rafe Lawson, the Executive Director of the Profitability Analytics Center of Excellence, PACE.
Well, thank you, Gary. That was a very interesting, amazing presentation. I'm sure we all learned a lot more about supply chain management and cost management, supply chain profitability and cost management. We are going to go to the Q&A session now. But before we do, I do want to push out the end of webinar poll. Before you leave, please make sure that you are respond to this poll. Stop sharing. Results. Stop sharing. I'm sharing the last one. Okay. Launch. There we go. Okay. We have the first question. I think it's very timely. Is there AI implementation opportunity to convert demon customers into angels?
Even customers into what?
Demon customers into
Oh.
angels.
No, into angel customers. Actually, AI is going to have a big impact. And I am just starting to investigate and understand it. And I'm asking a fair number of people, how can AI basically apply to management accounting? And one of the examples might be that you could ask AI for a certain industry. It doesn't always have to be manufacturing. Maybe it's like banking or insurance companies. Can you give me an activity dictionary? So could AI go look at an organization chart, let's say of an insurance company, look at the various departments. Let's say that there's 10 departments, and basically say, here's the 3 or 4 work activities that each department does. That's just one example. Maybe activity drivers. That would be, once you have the activities costed out, you reassign the activities to the products and services. What's the driver quantity, or what is the type name of the driver before you even get the quantities? So, AI is the new kid on the block. It seems to be pervasive everywhere. And, a lot of people remember when the internet came out, we went, this is revolutionary. Some people are saying AI may be of the same order of magnitude as the internet. So that's my probably too long of an answer.
Oh, but it's a good one. Uh, there's a question regarding Darwinian behavior. How do you change the mindset and behavior of management and leadership if company growth is suffering because of conservative cost issues?
I didn't have the slide in my presentation, but if everyone wants to just on a piece of paper write this equation I'm about to mention to you, it's D times V times F is greater than R. So the D times V times F, put that in open and closed parentheses. D as in dog, V as in victory, F as in Frank, and then greater than R. R stands for resistance. So if you look at the 3 to the left, D, V, and F, because it's multiplicative, if any of those are 0 or very small, the left side will not overcome the right side. So you're all asking, Gary, what's D, V, and F? Well, I'm glad you asked. I'll tell you. D stands for dissatisfaction with the current state. Unless people have discomfort, they're unhappy, pain, they're not basically going to change. V stands for vision of what better looks like. It's the solution. So if you've got big D in abundance, very painful, and you've got solutions, activity-based costing be a solution, you'd say, I'm home free. I'm going to overcome the resistance. But F is the sleeper. F stands for first practical steps. Because if they believe your V, your solution, like activity-based costing, is impractical, overly theoretical, unaffordable, they're not going to change. So, but this equation, what I've learned in my career, because earlier in my career, because I'm a V guy, I'm a vision guy, I'm the solutions guy, I was always basically trying to explain how it works. Over time, I've changed my style when I interact with people, ask questions, get that discomfort up. I know it could be career limiting if you go to the CEO and say, oh, do we know where we make or lose money? Yes, we do. Why are you arguing? But you've got to basically create the discomfort. And if you can remember this, one other thing I'd like you to remember in this of today, other than in the absence of facts, anybody's opinions go, remember this. In the past, the best leaders and best executives had the best answers. Today, I do not think that's the case. Today, the best leaders and best executives have the best questions. There's too much uncertainty. There's too much complexity. There's too much volatility for them to rely on their gut feel or intuition or the types of answers they had earlier in their career that got them promoted to the top. They need to create a culture of investigation and a discovery and analytics. And this is where that whole world of analytics, business intelligence, regression, correlation, clustering, segmentation. I know some of you took those courses in college. You wanted a passing grade and get the heck out of there. Well, sorry, it's here. But the good news is you don't need to go in your basement or attic and dig out your old college textbook, but you need skill sets in your organization that can do analytics. So any other questions, Rafe?
There are several other questions, and we're only have time for one more. So I'm going to combine them, hopefully, in a good manner. And it's on a topic very near and dear to your heart, Gary, which is basically obstacles to implementation. So one of them is, what are the basic drivers of ABC that people are unable to understand? They won't adopt the change and therefore keep using traditional costing methods. And then the other question is, how do you change people's incentives? In public companies, they're driven by share price and markets. They look at external reporting. And privately held companies are the ones who internal reporting matters, but many owners don't even manage by numbers, much less worry about ABC costing.
Let me do the second question. I learned something really early in beginning with ABC to sustain ABC. So it'll be refreshed at periodic intervals, like quarterly, maybe monthly. Hitch ABC to another wagon. And what is that other wagon? KPIs. KPIs that are derived from strategy. And this is we get into the Kaplan, Professor Robert Kaplan, the same creator of ABC. You know, his big book in the 1970s, Relevance Lost, The Decline of Management Accounting. That's when Kaplan promoted ABC. Kaplan did not invent ABC. ABC is just full absorption costing done correctly. He researched it. But he also co-created with Dr. David Norton, the strategy map and balance scorecard. So if you hitch the ABC output to the wagon of KPIs, and a good example, let's get to incentives, have the sales force not just have a single incentive commission of sales, 100% sales by customer, but a blend like 60% sales, 40% customer profitability. So when the sales director has their planning meeting, they will actually have profitability. And I know we're at 10:59, so I have to finish this because we can't go over. But that way, the sales force now is motivated to basically create more profit with harmony with its expense structure. Rafe, thank you, Pace, for inviting me to present this webinar.
Well, thank you, Gary, for presenting. Again, it was very interesting, and I think we all learned a lot. Thank you for everyone who attended today. Keep an eye on our Profitably Analytics Center of Excellence channel on LinkedIn for other webinars in this series. Sign up for our newsletter. We'll, details about who's speaking and when. And again, thanks for everyone for attending. If you want to become a member of PACE, it's free. You'll get access to all of our many resources. Just go to profitability-analytics.org and sign up. So with that, we'll end the webinar. And again, thank you, everyone.